Picture this. You're sitting across from your college roommate at a diner, splitting a check. You both graduated the same year, same degree, same GPA. But 5 years later, he just put a down payment on a house, cash, while you're quietly doing the math to see if you can afford the pancakes. Your stomach tightens. You think, we started at the same place. You tell yourself it's luck. Maybe his parents helped. Maybe he just got a better job. You reach for whatever explanation makes the gap feel smaller than it actually is. So you go home, open your laptop, and search how to build wealth. And for a few months, it's motivating. You read the books, you track your budget, but then life happens. Rent goes up, car breaks down, the credit card balance creeps back. Suddenly, your $500 savings is gone before it ever turned into anything real. This is what I call the wealth gap illusion. It looks like income, it looks like luck, but it's actually a beliefs gap. A set of deeply wired mental rules about money that rich kids absorb before they're old enough to question them, and that nobody ever hands to the rest of us. My name's Alex, and I've gone uncomfortably deep studying the psychological and financial patterns that separate generational wealth from generational struggle. Not just the numbers, the invisible operating system that runs underneath the numbers. And what I keep finding is that the gap isn't about what people earn, it's about what they believe before they ever earn a dollar. If you've ever felt like you're doing everything right but still falling behind, or if you grew up in a house where money was a source of stress, not strategy, make sure you hit that subscribe button and give this video a thumbs up if this opens your eyes. And if you are serious about changing your financial future, do not close this video with checking the links in the description, because today we aren't talking about budgeting tips or investment apps. We're talking about the psychological blueprint the wealthy pass down like a family heirloom. We're going to expose the core beliefs that keep rich kids rich, show you why nobody ever taught these to you on purpose, and hand you the exact mental rewires you can start using today. Here's the thing about generational wealth. It has figured out the ultimate hack. Wealthy families stopped trying to hand down money alone and started handing down the mindset that generates money over and over across every generation. A few decades ago, wealth was simpler to spot. It was the family with the biggest house on the block, the nicest car in the driveway. Today, the truly wealthy are often invisible. They drive normal cars, wear unremarkable clothes, and their real assets, the ones quietly compounding, are completely hidden from view. The game shifted from displaying wealth to multiplying it. This shift from spending wealth to growing wealth was not accidental. It was engineered through decades of repeated family conversations, dinner table lessons, and model behavior. Rich kids watch their parents treat money like a tool, not a reward. Middle-class kids watch their parents treat money like a finish line. When you get it, you spend it. When it's gone, you panic. So without realizing it, you grew up paying an ignorance premium. You paid with bad decisions, missed opportunities, and years of spinning your wheels, not because you were lazy, but because nobody gave you the map. Let's look at the first belief. Wealthy families teach their kids that money is a resource that works for you, not something you work for and then spend. A middle-class household might celebrate when a paycheck hits. A wealthy household asks, where does this dollar go next? One family is playing checkers, the other is playing chess, and they've been playing it since they were in elementary school. Why does this matter so much? Because the mindset of deployment versus consumption changes every single financial decision you make. A rich kid who gets $1,000 thinks, how do I put this to work? A kid who grew up watching money disappear thinks, I finally have some breathing room. Same $1,000, completely different outcome 6 months later. Wealthy families know that money sitting still is money slowly dying. But the real wealth destroyer hiding in plain sight is the relationship with debt. This is something nobody talks about openly enough. Most of us were taught, either directly or by watching, that debt is shameful. You borrow because you failed to save. You borrow because you couldn't afford something. Debt equals lack. But walk into any wealthy family's financial strategy session and you'll hear something completely different. They talk about debt like a lever, like a tool with a trigger. They distinguish between debt that costs you money and debt that makes you money, and they only willingly use the second kind. When a wealthy family takes on a mortgage, they're thinking about the asset on the other side of that loan, the equity, the appreciation, the tax advantages. When someone without that framework takes on a mortgage, they're just thinking about the monthly payment and whether they can afford it. One sees the vehicle, the other only sees the gas bill. And the numbers here are brutal. If you've carried a credit card balance at 22% interest, which is the average today, while your wealthy peers were deploying capital into assets returning 8 to 10% annually, the gap between you compounds every single year. It's not just that you're losing money, it's that they're gaining it at the same time. The distance between you doubles before you even realize the race has started. Now let's talk about the crisis moment, because every financial belief gets tested when real life hits. Medical bill, job loss, car engine. These are not if moments, they are when moments. A broken transmission is $3,000 to $5,000. A single emergency room visit without insurance coverage can run $10,000 to $30,000. A roof replacement on a modest home runs $8,000 to $15,000. These are not freak disasters. They are scheduled interruptions in the lives of anyone who owns anything. And if you don't have a framework for them, they will detonate your financial progress every single time. Most people who weren't raised with wealth have no system for these moments. They reach for the credit card, they take the personal loan, they raid the retirement account, they pay 24% interest on a $4,000 car repair for 3 years. The car gets fixed, but the financial foundation cracks a little more each time, and nobody told them it was supposed to work differently.
The trade-off is invisible but devastating. The car moves again, but the compound interest on that debt moves too, in the wrong direction. Every emergency that isn't funded in advance becomes a tax on your future self. This brings us to the risk conversation. The one that splits the wealthy from everyone else more than almost anything. Is taking financial risk reckless or required? Here's where it gets complicated. Wealthy families don't avoid risk, they calculate it. There's a difference between a 22-year-old with a trust fund taking a shot on a startup and a 22-year-old with $800 in their checking account doing the same thing. The risk looks identical from the outside. The downside is completely different. One fails and goes back to a safety net. The other fails and goes back to zero, or worse. But here's what wealthy families actually teach. You build the floor first, then you take the swing. Emergency fund locked, basic assets covered. Then and only then do you accept asymmetric risk. You bet on things where the upside can be enormous and the downside is survivable. Over a lifetime, the math is often worth it. Without the floor, every risk is existential. For people who didn't grow up with this framework, risk feels like gambling because nobody explained the structure around it. So they either avoid all risk and stay stuck, or they swing without a floor and get knocked out permanently. Neither outcome builds wealth. We also have to talk about the social inflation piece, because this one is particularly brutal. Growing up without wealth in a world that signals status through spending is a trap that's almost impossible to see while you're inside it. Keeping up with a certain lifestyle used to be optional. Today, it feels like the entry fee to adulthood. You need the right neighborhood, the right car, the right wardrobe, the right phone, not because these things bring joy, but because opting out feels like announcing your failure. And so you spend. You spend on things that depreciate while your wealthier peers quietly invest in things that appreciate. That's $400 a month in car payments. That's $4,800 a year. That's a fully funded Roth IRA contribution every single year going into a vehicle that loses 15 to 20% of its value the moment you drive it off the lot. Meanwhile, someone with a different money blueprint is driving a paid-off older car and putting that same $400 into an index fund and watching it compound quietly in the background. You're trading your future financial security for a present image that nobody is actually tracking as closely as you think. And the terrifying part is that you were never taught to see the trade you were making. So how do we actually close this gap? How do you install a wealth mindset when nobody handed it to you at the dinner table? It starts with the most uncomfortable reframe, separating your identity from your spending. Wealthy families do this automatically because they were never taught that what you buy is who you are. They buy what's useful and invest the rest, without shame, without status anxiety. You have to consciously unlearn the equation that says spending equals worth. You are not your apartment, your car, or your wardrobe. You are your net worth trajectory, and that is built in silence, not on display. Next, you need to start treating money like a system, not a mood. Rich kids grew up watching their parents have structured, unemotional conversations about money. They saw budgets as boring tools, not moral report cards. You need to build the same architecture. Automate your savings before you ever see the money. Separate your funds into specific buckets: emergency, investment, spending. When money has a job before it arrives, your emotions never get to vote. Then learn to distinguish between the two types of debt. Good debt goes toward assets that grow. Bad debt funds things that disappear. Before you borrow anything for anything, ask yourself, in 5 years, will this loan have built something or consumed something? If the answer is consume, exhaust every other option first. And finally, build the floor. Before you think about investing, before you think about side hustles, before you think about anything else, build an emergency fund that covers 3 to 6 months of real expenses. Not all figure-it-out money, actual designated untouched reserves. This is the foundation that separates calculated risk from blind gambling. This is what gives you the ability to take swings without being knocked out. The wealthy stay wealthy because the system they grew up inside exploits your fear, your status anxiety, and your lack of a blueprint. They didn't build something you can't access. They inherited a way of thinking that you can learn, but only if someone finally puts it in front of you in plain language. Don't let the gap between your upbringing and their upbringing become a permanent ceiling. The beliefs are learnable, the systems are copyable, and the math, if you start today, even imperfectly, will eventually work in your favor the same way it worked in theirs. Your bank account doesn't care what your parents made. It only responds to the decisions you make from this moment forward. And those decisions start with what you believe about money, not what you earn. If this video made you realize there's a belief you've been carrying about money that was never actually yours, that it came from your environment, not your choice, drop a comment below. Tell me the most expensive money belief you grew up with. Let's name it, unpack it, and then let's stop letting it run the show. Thanks for watching, and I'll see you in the next one.